Everybody, our topic for today is macroeconomics and behavioral finance. So, in macroeconomics, we're going to discuss a lot of factors that influence the price of gold, and we're going to discuss the role of gold in the world economy too. We're going to discuss major news to events that affect the price of gold too. We're going to go through behavioral finance then. So, first, let's start with the table of contents. So, first, gold vs the dollar, the US dollar. Second, Porter 5 forces analysis. Then, third, the most important economic indicators affecting the gold price. Then, the direct economic impact of gold trading. Fourth, the impact of trading gold on the global economy. Then, finally, the major news events. So first, let's start with the gold vs the US dollar. So the gold vs the US dollar is basically the US dollar here is the benchmark of gold prices. Good. Any other currency that holds gold rates is just a translation from the US dollar into the direct currency. So the US dollar currency is the benchmark of gold. And now let's talk about the correlation between both of them. So the correlation between gold and the US dollar is basically -1. Which means what? Whenever the gold actually goes up, the US dollar will be going down. We can see some interfering sometimes, which we call them anomalies, which actually they represent what? At some certain economical events, we can see the DAXI is just now moving down much when gold is just moving down, or both of them they're moving down, but that's just during the intraday trend. Good, but the overall correlation between both of the instruments is -1. Then we're talking about Porter's 5 forces analysis, which is basically, it's a tool and framework used to explain 5 main factors that influence any industry. In this case, we're talking about gold. So in gold, we have 5 forces that actually influence the industry. First one, a threat of new entrants. Second one, suppliers' power. Third one, buyers' power. Then the fourth one is availability of gold. Fifth is competition too. Okay, the threat of new entrants. It's like any industry can face several barriers, right? So in particular, the financing situation barrier. How to finance gold, the measurement of gold's rates too. So for this specific situation, when we're talking about a precious metal and a valuable metal, it represents what? An intensive capital, and it's always a catch for investors or decision makers to start working with to increase their profits too. Because if you look at gold and you compare gold to any equity market, S&P, NASDAQ, whatever, Dow Jones, gold has been actually outperforming everything for the last 20 years. So it's just gold is a safe haven that catches the eyes of investors and smart money too. So, and they always seek to make profit there because it is a steady profit, and no matter what, the price of gold just depreciate, it won't depreciate that much too, due to the psychological aspect that it's actually correlated with us as humans from a long time ago too. So therefore, the gold industry is always facing a new entrant threat, which will do what? Which basically sometimes it might just appreciate the price too much, as what happened in this last quarter. Gold prices just went crazy directly, and instead of just reaching that 2000 area by the end of this year, it just reached it in no time to. This is because the threat of the new entrant. Good. And When we measure capitals too for institutions and smart money, we'll be like us as retail traders or individuals, we have a low capital too, so we cannot actually move the prices that much. But when we're talking about some smart money, institutional and really wealthy individuals, they can really shift the market aggressively. So this is the threat of a new entrance too. Yeah, you can always check the DAXI to see the correlation. It's always minus one. 99% of the time is minus one. Because we said gold is the benchmark of, sorry, the dollar is the benchmark of gold too. So now suppliers power. In suppliers power, like to mine gold, it requires like an existing land that actually has some gold inside it. But many countries actually won't give us the permit to mine gold. Good. Because it might be like just like a fear of environmental risk of mining too. So, and this risk is considered, this threat actually is considered really, really, really high because it might actually affect the prices of gold. Because assume that because we know the supply of gold is really limited on this planet, right? So assume that we don't have more gold, but we have a lot of lands to mine, but governments are not giving us permit to mine them. This will actually drive the price really, really, really high with wide spreads too, because the lack of liquidity. So this is a really tough situation on like in this point. Then buyers gold. So gold is a commodity at the end of the day. Okay, we trade contracts, but at the end of the day, gold is just a commodity. It's just a product. So all of the investors, buyers, like gold, industrial related markets too, they always seek the cheapest price, the lowest price to buy gold. Good. And because gold is tradable and we trade it and it has some exchanges too around the globe because it's a commodity too. So the rate is changeable too. It just keeps on changing too. It's not just fixed. The market is floating. So this sometimes might affect some kind of manipulation too in the market. This is why we call it a liquidity grab. Good. Then when we talk about the availability of gold basically holds really, really, really great advantage over the world currencies. And it's been used for the entire history as a currency till now too. We still use gold. It's not as a form of currency, but we can exchange really a lot of stuff with gold too. Good. And that's why we can even exchange gold with currencies too. That's why the new system now is just backing currencies with gold too. Because there is a value for this commodity. But regardless that gold is also considered as a really great investment, hedge to risk, hedge to inflation too. So this rate is low, but still may increase as other metals like diamond are becoming more popular among individuals. So it's a normal threat, the availability of gold, but and doesn't mean like, okay, raising of new commodities or like precious metals will take the place of gold. That won't actually happen. Because even if you buy diamond, you cannot even exchange diamond with gold. Why? Because diamond doesn't really hold the same sentimental value like gold and psychological value. Good. Competition. So, gold is just a commodity, but this commodity is used in a lot of industries too. A lot of industries. So, if actually like the competition on gold raises in the industry, this will actually differ the prices too. Why? Because we use gold in different industries. As you read in my book, we use it for tech, we use it for like household, and we refine gold, we recycle gold too. So the most important economic indicators affecting the gold price. First is the supply and demand of gold. Second, monetary policy's direction. Third, global economic situation, inflation and US real interest rate. So when we talk about just gold prices, the first thing might just occur to us or like put up in our brains is what? Geopolitical like instability. If there is a war, if there is like a volcano somewhere is like booming too. So why is that? Because all of the economy that has been built during the last century, it was built on numbers, algorithms, So there is no real value for it too. It's just been based on depth and speculations too. So gold is the hedge for all of these speculations, depth, and algorithms. That's why gold just like whenever you see like just a bomb bombed in somewhere around the globe, you can see it on the chart. You can just open the 5 minutes chart and you can see it there. Right. So it's the same too when we talk about supply and demand of gold. It's actually like the high thing or like the most factor that can actually affect the prices of gold, which is the supply and demand of gold. So if we have a lot of supply, of gold, the prices what? Prices won't go higher. Why? Because we already have a lot of supply. So because our asks are meeting our bids too. Whatever like the investors or whatever like just demanding, we have a lot of supply to cover it. So that would be actually to drive the price down. You can even see it on the chart. When the trend just approaches a new area of resistance, or I call it supply or sensitivity area, you can see like if it's a really tough one, you can see like, okay, then down, right? It's coming up, but then it shifts. Why? Because we have supply here around these prices. A lot of people are actually interested to sell around these prices. Good. But what if we have a lot of demand? What if we have a lot of demand and we don't have that much supply to cover that demand? We have a really low supply to cover this demand. Then the instrument will just keep on going up, right? And you're going to even to be shocked now. The most demand that on gold is coming from central banks. Can everybody answer me why? Like the demand is just mostly coming from central banks. Okay, now monetary policy direction. So what we when we just like think about monetary policy direction, and its impact on the intraday trend, we just don't want to like think about the long-term trend at the moment and the long-term impact. If we just think about the intraday impact, whenever we have news regarding like a monetary policy direction, we can see how gold can be volatile, right? And we already talked about the relationship between gold and the US dollar, the DAXI, right, which is -1. So a monetary policy direction, it actually has some implementations, includes increasing the deposit reserve ratio, lifting the discount rate, and so on. So these implementations might have some impact, or not like will have some impact on the supply of money. So what do you think that might happen if we increase the supply of money? We'll have a really noticeable decline in the purchasing power of that currency, right? That's for instance when central banks or banks print money, that will happen. We do what? They do what? Sorry, they significantly increase the supply of money. So that gives what? That will make that currency not worth that much anymore. This will actually decrease the purchasing power of that currency too. So, and this will, on the other hand, this will do what? This will cause actually the gold prices to rise. And vice versa too. So if they do what? So let's say if they do decrease the supply of money, what will happen then? The purchasing power of that currency will increase, right? And gold prices will actually devaluate, and that will happen during I guess May, right? So they always play with the deposit reserve ratio, whether they want to increase the money supply, decrease the money supply, is through a couple of tricks. Some of them we talked about, liquidity trap theory. So in liquidity trap theory, what they will do actually, they will just, okay, they've been, our interest rate, let's say it's 2%. At this rate, we have a lot of people saving money in their saving accounts. Why? To get this 2% installments a year, or like it depends on the contract. Good, but it's annually. So what they do is they make it zero, or like, yeah, they cut it. Let's say zero. And this will do what? Are you going to still just invest, save your money when you're not like taking money? No. So investors or like savers will take their money out of their bank accounts. These are like their bank accounts. They'll take their money out of the bank accounts and invest it. Equities, bonds, gold, whatever, any kind of instrument. So this is a trick called what? A liquidity trap. Why? Because they don't have that liquidity and they don't want to print more money, so they don't decrease the purchasing power of that currency. So they do what? They just decrease the interest rate, so their currency will devaluate, right? And they have more supply of the currency, of the money, then what will happen? People need some return, right? So they will start investing in different sectors, mostly bonds and equities. And that's what happened in March. Federal Reserve did this trick, the liquidity trap theory. They did it. They cut the interest rate. People took their money, put it in bonds, put it in Dow Jones, S&P. That's when we saw Dow Jones start to appreciate again, S&P, NASDAQ. So they increased their supply of money by just doing what? By just doing this, by devaluating their currency without printing money. So they don't have inflation then. Which inflation is just a scam, by the way. We'll talk about it later on. Good. Any questions? Let me stop recording. So now let's talk about inflation. So it's actually known in the financial sector, or like any kind of sector, that gold is used as a hedge against inflation, right? So when gold appreciates, it means that there is inflation in the economy. But this year, especially this year, what happened wasn't even inflation. Good? So if you just think about it that way, when you increase the supply of money, this will generate what? This will influence the economy. Why? Because we'll have the currency purchasing power is devaluating or declining, right? So this will bring what? Inflation to life. But what happened now wasn't inflation. Why? Because they didn't print money. It's just they took our money without us noticing that. And as I said before too, a lot of investment funds are coming from the bond stock market. Then going to many sectors, such gold too. Because if you have an inflation in the country, good, or an economy, what will happen? Investors will take their money out because they need liquidity, and they're going to put that liquidity in work. They're going to put that liquidity into safe havens, gold in general. So by this, we're taking the money out of the bond stock markets, bonds, equity markets, putting them back where? Into gold. So, and why does it even like use that like that? Because of the relationship between the gold and the US dollar too. We talked about that, which is, okay, whenever gold appreciates, dollar will depreciate, right? So the correlation between them is -1. They move in different directions. It's like a mirror. So if gold is going up, dollar down. If dollar is going up, gold is going down. So That's why they also play with what? With the interest rates too. Because interest rates will be adjusted to inflation. That's the reason why they cut interest rates to zero too. Because they don't want to increase the inflation to them too. And they want to just fix it around a certain ratio or a certain number. So, and it's proven to, I'm gonna send you the study too, the case study with some statistical data, which whenever the interest rates are low, the prices of gold, or like investors are willing to hold gold more because there is no more other options to them. It's either like they save money and they take the interest rates, or or they invest in equities and the bonds market. But what's up with the equity market is pretty expensive too. It's the same thing when we talk about the global economic situation too. When there is such instability around the globe, where would you put the liquidity you have? All of that cash you have, where would you just put it? Would you be just like Venezuela, holding some cash with some value, and within a couple of months or a year, the cash you're holding, it doesn't worth any much, like anything anymore too. So that's even a risk too. So that's even the reason, like when we see like an earthquake happening in Japan, you'll see that Japanese yen is depreciating because this actually represents economic instability in that country at that point. And not really us, not us like the public. I'm talking about like smart money, all of that smart money that moves the market will be going to gold, because it's the safe haven. No matter what, gold won't lose its value. But a certain currency can drop 500 to 600 points a day if an earthquake happens, a volcano explodes, or just a terrorism attack, or what? Or a war too. We look at Iraq too. Like Iraq dinar was worth a lot of money, and after the war, it's nothing. Libya too. We look at all of these countries, so it's just clear for that. So any global economic situation that results in instability in any given economy, that will do what? That will result gold prices to rise and appreciate. So the direct economic impact of gold trading. So here we're going to talk about the relation between gold and the stock prices, the international and domestic economy too, and economic strength. Before that, I want to make sure that the last section was, you guys understood the last section. Okay, so the relation between gold and the stock prices. So in general, like in really general way, if gold is rising, then the stock market is falling. But when the stock market is rising, falling, the gold prices are rising. But here we can come to an anomaly that happened last quarter. which was what? Which at some certain period, we saw gold rising and Dow Jones is rising at the same time. Why is that? Because we talked about it last chapter, you know, because investors are still willing to hold the prices of gold. Why? Because that theory been tested that whenever the interest rates are really low, investors tend to hold gold more too. And we exactly know who's like the biggest holder of gold too, which are like central banks, right? And then you have what? Then you have like stock market indexes are actually directly linked with gold mining companies. So if we look at it like, okay, in other words, the price index in the long run, both variables actually influence each other in the short term. Good. So this means the relationship between gold prices and the stock market prices is a negative relation too. Because if you're holding gold, how are you going to be able to buy stocks? Don't you need liquidity for that? Okay, didn't you spend dollars or any currency to buy that gold? Okay, don't you even need liquidity to buy the stock or share you want to buy or whatever, you know? So yeah, just it's there, you know. You gotta make sense out of it. Then, okay, so the international and domestic economy. So we all know that gold plays a direct and indirect role in the international and domestic economy. So, in one hand, some countries, gold accounts for a very high percentage of their merchandise export revenues. And on the other hand, too, gold is also considered as a remarkable source of government revenues using taxes and other processing activities. Does that make sense? You got some countries that their revenue is mainly coming out of gold, like some most of African countries, from mining gold, from trading gold, like Fiscal gold too. Then when you got like, on the other hand, is what? Whenever you have like a really strong economy, really have like a really strong economy, then you have what? You have gold prices are high. Why is that? If you just think about it for a second, that's when we're talking about a really strong economy, and a really strong economy comes with what? Comes with some kind of equilibrium too for cash flow, their employment rates. So even for income too, like how much money employees, workers, you know, make money there too. So because the economy has a really direct relation between gold and the economy or the cash flow inside the economy too. But not just gold. If you have really a really good, strong economy, which doesn't really exist in the means of classic economics, then you'll have like a really strong stock market too. Because at that point, you'll have that equilibrium point, you know, in the economy. You'll have a strong cash flow, strong income too. So you have an a balanced portfolio too. And that balanced portfolio will be what? Investing in gold, saving accounts, stock markets, bonds, etc., etc., etc. But that doesn't mean that everything is going to be weighed the same. Like some of the instruments are going to be high, some not too. Like that doesn't mean that okay, the economy is really strong. Then okay, stock market is rising, gold is rising. That doesn't mean that both gonna give you the same returns too. Gold will always overperform all of these assets. It's it depends on it's actually coming from our human nature too. Good. On the other hand, if you have a really weak economy too, that will affect the whole cash flow cycle in the economy too. You ain't got no money. You even ain't got no money to buy food. How will you have like a strong stock market? Uh, so that doesn't make sense too. So if the economy is strong, then you'll see that okay, gold prices are rising, stock market is doing good because the cash flow in the economy is actually really good too. So at this point, some are saying that okay, the US economy is not as strong. But what I say, it doesn't matter like the debt they have, but their economy is doing really good. Why? Because you got gold is rising against the dollar first, then second you have like okay, their stock market has been rising too during the pandemic too. That means what? Their cash flow in the economy is pretty neat and smooth, right? So record. Okay. So in this section, we're going to talk about the impact of trading gold on the global economy. But we already talked about the supply of gold and the demand of gold and their impact on the global economy. Now we're going to go through the recycling of gold, which is a topic that represents a really good weight of, let's say, the index of gold or the production of gold a year. So in fact, recycling counts of 1/3 of the gold supply. So 1/3 of gold supply is coming from recycling gold. And it's really directly linked to gold consumption, not gold to mine production. Because, okay, you consume gold, maybe for jewelry or tech, and then, yeah, you sell it back. Then they recycle that piece again. So it's directly linked to the consumption of gold, not even the production of it or like mining gold. Oh, it's actually I've been looking through this topic because I had it like in my thesis and I needed like to get some exact numbers, accurate numbers, but it cannot be measured, because it's so random too. It just cannot be measured. Especially like okay, all of these refining companies and stuff, most of them are private, and even the regulations for them is just so limiting and restricting the data to. They don't give data about this, all of this too, because it has been said that the recycling is around almost like 1,000 tons, because even you have the yearly consumption of gold is around 2 tons to 4 tons. It's been for the last 3 years around 4 tons. But once you get that recycling data, you're going to exactly know, like, okay, what's up with the weight of the price too. So they've been always restricting and limiting all of these data about this specific sector, which is the recycling sector of gold. When they have their own, when they have their own like market, their own prices too. The price releases every day around 12 p.m. and 5 p.m. for this recycling sector. So this is the dark side of gold, the recycling of gold. It is the dark side of this industry because you cannot find data about it. They're just saying that from the Gold Council, like the World Gold Council, that it's 1/3. But then once you go deeper inside, like into this rabbit hole, you can find data about it. And why do they release special prices for refiners too? Yeah, maybe. Yeah, okay, I get it because okay, I'm buying an ounce as like a jewelry designer. I use like let's say what like half of the ounce, Now it's broke. Now I gotta resell it. Blah blah blah. So and it is called like gold fix. It is gold called gold fixed prices. Gold fixed price. See, they release it twice a day from this website, Kitco. And even if you try to contact this firm, which I contacted when I used to work for the broker, because we had a lot of like fiscal gold traders dealing with us. Good. They don't give you access to the data. They just give you access to the release, and the release is like after 30 minutes or 40 minutes of the actual release too. So this is actually the dark side of gold, the gold market. Okay, now let's talk about major news events. So we got central bank meetings, unemployment rate, consumer price index, GDP. We got two inflation and interest rate decisions too. We got political speeches, central bankers like speeches to terrorist attacks, volcanoes, earthquakes, so on, so forth. All of these like global situations which represent instability. So central bank meetings, they're oh my bad, sorry. Central bank meetings, they represent volatility. Why? Because we talked about it. They have the monetary policy direction too. So they be discussing some aspects about the monetary policy direction, which brings volatility, because they might change their mind and come up with a new idea, blah, blah, blah. So this will give an edge for like future plans and so on. Good. Then you have the employment rate. Employment rate, because this current, let's say, economy is based on employees. So you need employees. Good. Why you need employees? Because you got the middle class are coming Most of the employees are coming from the middle class. Then you have the middle class, which is the soul of the country or the economy. The middle class is the one who is spending money, saving money, trying to invest, mostly spending money too, you know. So unemployment, if the employment rate is higher than expected, then it's what? Then it's resulting a bullish movement or volume, you know. If it's lower than expected, then it's going to result what? A bearish volume. Good. Consumer price index. So I talked about it. Like everything is just, you notice, I hope that you notice that everything in economics is just directly correlated, you know. Is once you understand the basics of it and you start researching, you start like connecting all of the dots together too, you know. So it's coming from here, you know. If nobody's earning money, you know, are they gonna buy products? If not, if they're not going to buy products and stuff, if there is no cash flow in the economy, then ain't nobody's going to buy from here, you know. Like this consumer price index will be minus. So these, all of these here affect what? Affect the intraday trend. They don't change the trend. They just affect the intraday trend. And I don't prefer to trade them. I traded NFP today just out of fun, you know, just like this, you know, like let me trade it and have some fun. That's it. Yeah, I don't trade it. I don't even advise to trade that too. So, but what we can do from this, we can continuously gathering data, you know, for a quarter to predict what's going to happen in the next quarter too. Good. And all of these here, the instabilities, you know, they can help us predict or speculate the future value of the economy. Is it going to be healthy? If it's not going to be healthy, you know. Good. Then we got gross domestic product. For me and for classic economics, and even modern economics too, this is one of the most important elements and factors in the economy. You know, it's even more than employment rate, more than inflation and interest rates. Why? Because I'm gonna show you the calculation now, the equation. So you got the gross domestic product. It's coming from where? Private consumption, which is the private sector consumption. Good. Private sector consumption. Then gross investment plus government investment. How much is the government is investing, you know? Then government spending. How much the government is spending. Good. Plus exports and imports. Exports and imports, you know. Your exports gotta exceed your imports, man. You gotta give more than you take. That's why Trump did that, or what he did with China, because they were just receiving a lot, man, more than they are giving. They were just receiving too much, more than they're giving. So that's why he did what he did. And that's why the US economy didn't crash because of that man, because he just fixed all of these, you know. He just
started to give money to like the private sectors, lending money, blah blah blah. Sorry, and the government investment too. Yeah, they still invested in military too, but you got the private consumption went higher, because employment rate was low, new jobs available always good. This results in what? More cash flow in the economy, gross investment, and you get the government investing in military, investing in the private sector, investing in the bonds market, so on, And what they did with China, they reduced their imports and increased their exports while increased the production, the domestic production of the country. Easy. So then you got political speeches, central banks. Then you got political speeches. They are so volatile because they may result some kind of influence on the economy too, on any given economy. There might be a conflict they're trying to solve. We saw that live about Trump and China, right? Then we got central bank speeches too, discussing some rates, some possibly new ideas, some so forth, so on. This is so volatile too. This is the most volatile one. Terrorist attacks and wars. Some economies like go to bankruptcy, due to terrorist attacks, wars, and all of this. So these are really volatile events. Plus volcanoes, earthquakes, so on and so forth. Because all of this will influence the functionality of the economy too. And instead of a healthy economy, this one here, a war, an earthquake, a volcano explosion, blah, 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 will make it an unhealthy economy. Terrorist attacks will make it unsafe to live there. So ain't nobody will be investing. That's why ain't nobody goes to Latin America to invest a lot of money to, because it's not fucking safe there to invest money to. But you can buy for cheap too, right? But you still take the risk on you. Then interest rates. Why? Because if they are increasing the interest rate, more investors are going to be willing to buy that currency. So that will be what? That will appreciate that currency. But if they are decreasing the rates, ain't nobody is willing to buy that currency. They're not gaining money out of that, right? Inflation. So we know what's up with the economy. Is the economy healthy? Is it not healthy? So overall, we don't trade this. We just gather all of these data, and we have, hopefully now, we have the knowledge to know exactly what's happening in any certain economy and know how to respond to it. Okay, now behavioral finance. But before we start with behavioral finance, let's take a break for 5 minutes.
Okay, ladies and gentlemen. So, friends, we're talking about behavioral finance, which is my field of expertise. So, sorry, behavioral finance basically is the field that has been discussing that, okay, humans, they are not rational and they don't take decisions to based like on to increase their utility curve. Good. So they don't take decisions based on gains or stuff. No, they just take decisions based on their emotions and how they feel about it. Good. Which is argue with classic economics too. Why? Because classic economics say that, okay, humans are rational and they take decisions based to increase their utility curve. When behavioral finance disagree with that and argue with that and says that humans are not rational and they take decisions to not to increase their utility curve and because they just felt like this, you know. So first, we're going to talk about the efficient market theory. Good. So efficient market theory. No. So an efficient market is defined as a market where there are like a large numbers of rational profit maximizers, you know, actively competing with each other, trying to predict future market values of individual securities, and where important current information is almost freely available to all participants. So the efficient market theory is not from behavioral finance, it's from classical economics, but I put it into neuroclassical economics, which is behavioral finance, and modern economics because it doesn't make sense. So this is why behavioral finance and neuroclassical economics argue with the classical economics. Why? Because such a market doesn't exist. Such market doesn't really exist. Yeah, we always trying to speculate and predict the future of market values, but do we all have access to the same informations at the same time too? No. Are we even competing with each other? So this here doesn't exist for me myself, you know. Even I put it in my book and in my thesis because my supervisor told me to do so, and he was, I'm not going to correct your paper if and sign it if you don't put it in like in the paper, because he's like, yeah, a classic economics believer or follower, whatever, you know. So this doesn't make sense to me, you know. And for us traders, it doesn't make sense at all. Let's not spend a lot of time on this. So, okay, prospect theory. Good. So the whole idea of the prospect theory that, okay, people think in terms of expected utility, expected gains, you know, expected return. They don't think about actual return. No, they think in terms of expected utility. So, which is basically, it's about risk seeking and risk aversion. Risk aversion. Good. So risk seeking is the acceptance of a greater volatility and uncertainty in investments or trading in exchange for anticipated higher returns. But risk seekers also are more interested in capital gains from speculative assets than capital preservation from lower risk assets, while most investors and traders are risk averse. So by risk averse, this explains the fact that we cut losses faster than winners because humans are seeking risk for losses but are risk averse for gains. Because once we're losing, we'll start seeking risk. Like, I want to risk my money, right? But once we're in gains, we're like, yeah, I don't want to risk my money too. Does that make sense? This
Yeah.
the whole this the whole goal of the prospect theory, which we can see here on the value function, which is the prospect theory curve too. You know, a person is seeking risk for losses because he's losing. He's now seeking. He's losing. Now he's seeking risk. But now he's in gain. He's now risk averse, like aversion. You know, he's being like, I don't want to risk it. Boom. Mental accounting. So mental accounting is, let me put it like this, a quick example of mental accounting. So a little bit of annotation might make it better. You got Khaled. Or like, yeah, X person, you know, his son is sick. Good. His son, this person is sick. So he went to the hospital. They gave him a prescription about like a medicine. So he went to the pharmacy to get the medicine. So he went to the pharmacy to get the medicine. And then they told him, like, okay, we got this medicine. We got two types of it. We got two types of this medicine. First one is like $200. And this one is like $20. Good. And this one is $20. So a first thing any human being is going to think about, okay, I want this one. I want the $200 one. Why? Because it's already linked in our heads that, okay, because it's expensive, then it's better. And since it's about my son too, so I'll be emotionally attached to the process. I want to be rational. But then you have this seen person, you know, or alpha, whatever, going through the same situation, same medicine, same everything, you know. So he went to the pharmacy and they gave him these two options. First thing he will ask, what? Like, are they the same? What are the differences? Is there like side effects? The made in where in USA, China, whatever, you know. And then the pharmacist will say like, okay, made in the USA, like the $200 is made in the USA, no side effects, and they both got the same ingredients. So then he will ask like, what about this? This is like made in Mexico, no side effects, blah, blah, blah. Then it's basically the same, you know, same medicine. So this X person picked this one directly without being rational because he was so emotional attached. But this alpha person asked these questions being rational and aware of his decisions too, not emotionally attached to make his decision. So mental accounting, it's all about budgeting and the way we think about money and the way we prefer our decisions over other decisions because of the way we think about money too. Perfect. Okay, let's now talk about investors' sentiment and the business cycle. Good. You always seem to see this if you're like aware of what's happening around you. Like for instance, Bitcoin, you know, it was like as it's at its peak, exactly at the peak of it. So we got like what? Optimism, excitement, thrill. It was at what? 17 to 20K. Then euphoria and anxiety, denial, I'm denying the fact that this is going down now. That this is going down. I'm neglecting all of the facts, I'm being stressed. I got in here, at the peak. I was excited. I was optimistic, Then I started going down. I started being anxious. Then I saw some signs. I've read some facts that this is how the market moves, This is the market cycle. And it's going down. No need for it to go up at the moment. But I denied it. Then it continued going down. I'm afraid, I'm being afraid. We talked about this before. We're still going to talk about it in the psychology too. My mind is in an error phase. I'm not able to think, or take some rational decisions, It continued going down. At this point, I'm fucked up. I'm depressed. I'm gonna kill myself. Like, I bought a 17K, man. I invested my life savings, blah blah blah, and now it's what? Now it's like I have 7K or like 6K. Kept on going down. Panic. I'm panicking. Going to sell. Then capitulation at its peak here. That's it. I'm done. I'm super done with this. I'm fucked up. My life is a trash. I'm a trash. Whatever, Same thing, depression. Then start going up. I get hope, relief, again, optimism again, So forget all of this. You shouldn't be emotionally attached to something. Good? First. Second, you should know that the market doesn't go like this. You know that the market moves in cycles. Perfect. Okay, let's talk about bubbles now. Let's talk about bubbles now. And the phases of the bubbles. Good. We got the stealth phase, which is what? Which is basically where is the smart money. All of the wealthy individuals, wealthy companies with some insights of the near future, what's going to happen, of the opportunity when it to present itself. It didn't even represent itself. It's at the beginning, at point zero. They enter with the most money. So take off. Then we got awareness phase, which what? Which most of investors will what? Will start noticing the trend. Will start noticing what's happening. Will start noticing the opportunity. Institutions, blah, blah, banks, wherever, all of these people start getting in. Then we have our first sell-off. Our first sell-off, why? Coming from these here, the smart money, cashing out a little bit of the money to do what? To bring a better price, which is a bear trap. Then it start going up. Mania phase. A mania phase is when everybody notices the opportunity. Everybody. When the media enters and stop saying about it, repeating more and more about it, This is the mania phase, when the public even anticipates the movements too. Then, media attention, bringing what? Bringing the mania phase, the public attention, everybody attention, which is already at this point, Then, boom, going up. Public already in. Enthusiasm. Greed, delusion. At this point, we saw people last year saying gold is going to have 200K, man. Delusion, bro. What you saying? What you talking about? The greed. You don't want to sell. They're just holding. Okay, what's up with these people, the people who started this trend? What's up with these people? By the way, all of what I'm giving you now, it can be used in trading. I use it in trading too. Because they are the same people who moves the trend every day. Smart money, picking orders, then dynamic traders coming, moving the trend with them, then public anticipating, losing money, getting stop losses, blah, blah, blah. Then yeah, B again. Same thing again. Smart money, sell off, institutions, then public, boom, then boom. You see this every day. A new diagram. Paradigm, sorry. Denial, again, that happens all of the time. You buy at resistance, you see it rejecting. You buy a resistance, you see it rejecting, boom, boom, boom. You're still denying that, nah, it's going to break out. Then, boom, down. Do you start being afraid because you're like, what, 30, 40% drawdown? Returns to the mean, which is the supply or demand, it actually took off from. Then again, same cycle, smart money, boom, boom, institutions, boom, public, boom, boom, boom. Again, smart money, institutions, boom, public, boom. Same cycle over and over again. So this was our class for today. I appreciate the time you spent with me. Hope you have fun with this.
Thank you, Khalid.
Thank you so much.